Okay. All right. Good morning, everyone. Sorry for the small delay that was there in your in starting the class. Okay. So, good morning, Vimal. Good morning, Deepak. Good morning, Shankar. Good morning, Yedu. Good morning, Vanshika. Good morning. So today we are going to start with the third step of revenue recognition, that is transaction price. Okay, that is your transaction price. Now, we have seen how many steps so far? We have seen the first two steps. The first step dealt with identifying the contract. The second step dealt with identifying my performance obligation. So these steps were essential, but the ultimate one is, sir, at what rate should I book my revenue? That is the ultimate step that we have to now look into. And then we have to look into allocating the revenue to the performance obligations. Then we are going to book the revenue as and when the performance obligations get fulfilled. Okay. So we now have the next step, that is your transaction price. We now have your next step, that is the transaction price. Just give me a minute. Okay. Now, step 3. Determining transaction price. Okay. Very crucial step, because this is the basis on which the revenue figures will start hitting the P&L. So when Ind AS 115 talks about transaction price, what do you understand by transaction price? Is it the price that the seller receives? Answer is no. It's not the price that the seller receives. It is the price that the seller expects to receive for the performance obligation that the seller satisfies. So when we talk about transaction price, it is the price expected to receive. Expected to receive for fulfillment of performance obligations. For fulfillment of performance obligations. That is why when we did the question on the very first session that we did, when we saw the sale of car coupled with a warranty, coupled with some free services, though the consideration received was 15 lakhs, we split it up into, say, 13.5 lakhs for the car and some X amount for the warranty and some Y amount for the services. Why did we do that? Because though I'm selling something for 15 lakhs in a layman terms, actually I have 3 obligations to fulfill. And those 3 obligations are separately identifiable obligations. And that is why I expect 15 lakhs as a combo offer for all the 3. I accept 15 lakhs as a combo offer for all the 3. But when I do the split accounting, when I do the splitting of the performance obligations, that time we are looking at what is the amount I expect to receive for fulfillment of performance obligations. So this tends towards not a contractual basis of accounting, but this tends towards a more fair value basis of accounting. This tends towards a more fair value basis of accounting. Revenue should be booked at amounts expected to receive means the revenue that is recognized should be on the basis of fair value, should be on the basis of fair value. So with that, we shall start our discussion on determining the transaction price. There are a couple of important pointers which we are going to discuss here. One of them is variable consideration. Then we have significant financing components. Then we have payments, receipt of additional goods and services from the customer. Then we have warranty treated separately. Then we have sale or return. Then we have restocking fees. And then we will be closing it with considerations payable to the customer. So these are the broad topics under this step number 3, which we are going to discuss. So the first one that we begin with is variable consideration. The first one that we start off is variable consideration. Okay. Now, what do you mean by variable consideration? Okay. That is the question. What do you mean by variable consideration? See, let us take an example. With the help of an example, it sorts out a lot of things. So let us assume that L&T gets a contract to construct a bridge. Okay, to construct a bridge. Now, the contract price is, let us say, rupees 3,000 crores. Let us say the contract price is rupees 3,000 crores. Okay. The time span given is 5 years. Construct a bridge in 5 years. Okay. That means at the end of 5 years, L&T must give the bridge constructed to the government that has awarded the contract for a consideration of rupees 3,000 crores. Additionally, there is a performance bonus. There is a performance bonus. What is the performance bonus? For every month of early completion, L&T is entitled to a bonus of 30 crores per month. So, for every month of early completion, L&T is entitled to a bonus of rupees 30 crores. So suppose it completes the contract. So we have 5 months, that is 5 years, that is 60 months. So if it completes the contract in 59 months, it will get a bonus of 30 crores. If it completes it in 58 months, it will get a bonus of 30 plus 30, 60 crores. If it completes it within 50 months, then 60 minus 50, 10, 10 into 30, it is going to get a bonus of what you can say 30 into 10, 300 crores. So this is how the contract is structured. Now, let us understand how this particular transaction was being done. Under the AS regime. This is a construction contract, so this would be covered under AS7. So you would recognize revenue on a percentage completion basis. So when we talk about percentage completion, let us assume that at the end of year 1, 10% is complete. At the end of year 2, 50% would be complete. At the end of year 3, 70% would be complete, and you are completing the project in year 4. Now, under AS7, how could you recognize the revenue? So it is a contract, so we follow the percentage of completion method. So under AS7, if all of you recollect, I would be recognizing, sir, bonus ka to hame pata nahi hai. We will be booking the bonus only if I complete the contract earlier, because I have learnt from beginning to be very conservative in my approach. So bonus, we will see if at all we recognize it later on. So 3,000 into 10%, I would be booking 300 crores under AS7 for the first year. For the second year, it is 3,000 into 50%, that is rupees 1,500 crores minus rupees 300, which we had recognized earlier. So this ends up with giving me rupees 1,200 crore revenue for the second year. For the third year, it is rupees 3,000 into 70%, 2,100 Up till last month, we have recognized 500. Last year, we have recognized 1,500. So therefore, we are now recognizing 600. In year 4, entire 3,000 is complete. So this is 3,000 minus rupees 2,100 is equal to rupees 900 crores. Plus, we are going to get a performance bonus. Instead of 5, I have completed it within 4 years. So 12 months bonus. So 12 into 30, that gives me rupees 360 crores. So therefore, the total revenue that you are going to recognize in the 4th year is 1,260 crores. And this is the way in which you will be booking your revenue under AS7. Are we clear with this? Are you able to understand that you used to do a similar calculation under your construction contracts, or whether you used to study your contract costing? A similar format, a similar model of revenue recognition was used. Are you guys able to recollect? Yes. Are you guys able to recollect? Yes. Are you guys able to recollect? Yes or no? Yes. Okay. So now, this was what AS7 used to tell us. Okay. Or AS9, whatever it is. Okay. The 30 crore bonus, which is given for early completion, this 30 crore bonus represents a variable consideration. Okay. Represents a variable consideration. What Ind AS 115 tells us is, why are you being so conservative in your revenue recognition? Why are you being so conservative? Be realistic. You are L&T. Okay. You are Larsen and Toubro. You have tremendous experience in infrastructure contracts. You have a huge team of people under you. You know where to depute the resources and how to get the work done within the deadlines. So let us be a little proactive and try to assess at the inception itself, at the beginning itself, whether I am going to complete this contract within a span of 5 years, 4 years, 3 years. Make a realistic assessment of that. And once you make a realistic assessment of that, you proceed to recognize the revenue. You proceed to recognize the revenue. Okay. So now let us suppose that L&T knew from the very beginning that this contract I'm going to finish it off within 4 years. I'm going to finish it off within 4 years. So chalo, let us recognize the revenue accordingly. So what Ind AS 115 tells us is, you are finishing the contract within 4 years? Yes, sir. So if you are finishing the contract within 4 years, please go ahead and recognize the total revenue that you expect to receive. Look at the words. It's not revenue, contracted revenue. It is revenue expected to receive. So at inception, revenue expected to receive is equal to 3,000 crore to fixed it. This is not negotiable. Plus rupees 360 crores. This is what you expect. Whereas this is the contracted rate. In other words, this is the fixed consideration. This is my variable consideration. So at the inception of the contract, you estimate that you are going to get 3,360 crores. 3,360 crores. Now, year 1, how much revenue L&T would recognize? 10%, 50%, 70%, 100%. 1, 2, 3, and 4. Okay. Now, in year 1, the revenue that L&T will recognize is 3,360 into 10%. Into 10%. So that gives you rupees 336 crores. That gives you rupees 336 crores. In the second year, it is 3,360 into 50% cumulative revenue. Into 50% cumulative revenue. So that works out to how much? 3,360 into 50%, rupees 1,680. Minus rupees 336. Minus 336. That gives you how much? 1,344. That gives you 1,344. The next step that you are going to do is into 70%. So 3,360 into 70%, 2,352 minus 50% is recognized. So subtract 3,360. Sorry. 3,360 divided by 2. So 1,680 you subtract. So 2,352 minus 1,680. I am going to book here 672. I am going to book here 672. And finally, 3,360, 100% is complete. So 3,360 minus 2,352. So that gives you how much? 1,008. That gives you 1,008. So my revenue numbers look something like this. Okay, my revenue numbers look something like 336, 1,344, 672, and 1,008 and 1,008. Okay, so now for the reader of financial statements, as well as for the preparers, as well as for anybody who has a basic understanding of revenue recognition, they will clearly look at, now, what is the benefit of this? See, I think there will be questions in your mind going about like, sir, how can we recognize that bonus if suppose हमने contract meet ही नहीं किया 4 साल में? So what do I do? Okay, so we'll come to that. We'll come to that. Keep patience. Okay, that will be covered. But as of now, let us see from the perspective of a person who is reading the financial statements. सबसे पहले AS7 की बात करते हैं. We'll talk about AS7. So now, year 1, he will look at 10% completion. He will look at the contract price in the financials. 3,000. Acha, 3,000 into 10% na, so he has recognized 300 crores. So very well, 300 crore hamara revenue hai. That is correct. It is fitting 3,000 into 10%. Okay. Now in year 2, the incremental percentage completed is 10 to 50, that is 40%. So 3,000 into 40%, what you are recognizing is 1,200. Very well. 1,200 is the revenue which is recognized. Coming to year 3, I have completed an increment of 20%. So 3,000 into 20%, that ends up giving you 600 crores. And what is the revenue I have booked? 600 crores. That is also fine. But coming to the fourth year, the reader is going to be confused. Sir, 30% of the work you have completed in year 4. Correct. So 30% के हिसाब से you should be booking 3,000 into 30%, that is 900 crores. But your calculation is giving us 1,260 crores. Why this particular anomaly? Why this difference? Why this gap? Why this what you can say mismatch? And then you have to end up explaining, sir, there is a bonus. The bonus component we do not recognize because we follow conservatism basis, and therefore we recognize only if we are doubly sure about the fact that we have completed the project. So then the reader of financial statements ke kaan khade ho jayenge. He will be very alert, and then he will ask the question, my friend, you are a company. A company has to follow accrual basis of accounting. That is fundamental. Then, going by your words, in year 4, have you followed accrual basis of accounting? What do you guys think? For the bonus, is the entity following accrual basis of accounting, or is it following a cash basis of accounting? What do you think? What do you think? Is it accrual or is it cash basis? Is it accrual or is it cash basis? What do you guys think? By recognizing the bonus in year 4 on actual completion, is the bonus being recognized in year 4 indicating accrual system of accounting or cash system of accounting? Cash system of accounting. It is cash system of accounting. That's right, Mohammed, Yedu, Saravanan, it's absolutely right. Others also, I hope you are able to understand. So we are recognizing bonus on cash. Am I deviating from accrual basis? Yes. Am I deviating from accrual basis? Yes, I am. However, my point is conservatism considered to be, a fundamental characteristic of financial statements? Yaad karo, a couple of weeks ago on the same platform before you guys, we had studied another chapter. That another chapter was what? That another chapter was conceptual framework for financial reporting. Let me open up that presentation so that you can refresh your memories. The conceptual framework. Yes. Now, in the conceptual framework, what are your fundamental characteristics and what are your enhancing characteristics of financial statements? Yes. Yes. What are your fundamental characteristics, qualitative characteristics? Sir, it is relevance. It is relevance, number one. The second one is faithful representation. That means it should be complete, it should be neutral with exercise of prudence, and it should be free from error. And when you look at your enhancing features, it is comparability, verifiability, timeliness, and understandability. In all these features, do you see conservatism appearing anywhere? Do you see conservatism appearing anywhere? Sir, neither supported by exercise of prudence. No. When I say neutral, I do not mean conservative. I do not mean being conservative. See, the problem with conservatism, which unfortunately you and I have been exposed to right from the beginning, is that do not recognize revenue until you are absolutely sure, until it has accrued, until it has crystallized, until it is guaranteed of getting that revenue or that income stream. Do not recognize is what has been ingrained. But so much of conservatism ends up in two things. First one, it ends up in deflating your profit and loss. It ends up in suppressing the profit. It ends up in suppressing the income. First. Second one, it can only end up in suppressing your net worth. It can end up suppressing your net worth or inflating your liabilities or suppressing the net assets. So this is the major flaw that we have with conservatism. In terms of the conceptual framework, conservatism is not, I repeat, conservatism is not a fundamental characteristic or an enhancing characteristic. Conservatism should be applied conservatively. Conservatism should be applied conservatively, or to use another English term, prudence should be applied prudently. You should be prudent with your prudence. Okay. हम लोग क्या करते थे? What did we do? Conservatism सब जगह पे डाल दो. Put it in every place that you see. Bonus. You know for sure this contract does not require 5 years. It is going to be done within 4 years. But अपने को तो conservative होना है. We want to be conservative. So conservatism के नाम पे what do? I book the revenue at 3,000 crores for the first 3 years. And in the 4th year, there is a jacking up of the revenue by the bonus component. Now, look at the purposes of look at the fundamental characteristics of financial information. Are you meeting faithful representation? Are you meeting faithful representation? In years 1, 2, and 3, you have thought that the revenue from this contract is going to be 3,000 crores. That means you have made the readers also believe that the revenue from this contract was 3,000 crores. In the fourth year, you are suddenly saying the revenue is 3,360 crores. Now, if it is 3,360 crores, then where have you faithfully represented the revenue numbers in years 1, 2, and 3? Have you faithfully represented? Answer to that is no. And because the answer to faithful representation ends up being no, have you complied with the conceptual framework at the time of preparing your financial statement? Answer is no. And therefore, in view of so many issues, what Ind AS 115 tells us is, yeah, go ahead, be confident. If you feel you can get that bonus of 360 crores because you are completing the contract within a span of 4 years instead of 5 years, please go ahead and recognize it. Please go ahead and recognize it on a percentage completion method. Not recognizing results in deviating from faithful representation. Recognizing gives us faithful representation. And we are prudent. We are L&T. We are having decades of experience, centuries of experience if you put the man hours that I have done. You have absolute clarity in where your supplies will come from, how they will come from. Your supply chain management is excellent. So when you know all these things, what is the harm in recognizing that bonus also? And that is why bonus component is going to be recognized. That is why bonus component is going to be recognized. Are we clear up till here? Are we clear up till here? The cash bonus under AS7 was booked on cash basis. Whereas in the case of Ind AS 115, the bonus also ends up getting accrued. Are we clear so far? Yes, are we clear so far? Yes, all right. Tanisha, Vanchika have confirmed. Now, my next point that I'm putting before you is, what is 336? Sir, 3,360 into 10%. What is 1344? This is 3,360 into 40%. Please do simultaneously so that you can confirm. Okay, so 3,360 into 30%. So in all these cases, is the percentage completion multiplied by the total consideration going to match with the revenue numbers? Yes. Is this going to match with the revenue numbers? Answer is yes. It is going to match with my revenue numbers. And therefore, the reader of the financial statements will also be very comfortable to look at these numbers, because I have a fair sense of estimate that I am recognizing my revenue on a neutral basis. I'm faithfully representing my revenue numbers. Okay. So that takes care of variable consideration. That takes care of variable consideration. Okay. Just because of the bonus, we are inflating the revenue by adding expected bonus. Therefore, in the first, second year and the third year, is the revenue inflated? Answer is no. I am backing my revenue numbers with decades of experience in infrastructure projects. I'm taking this specific example. I am backing my estimates with the man hours that I'm having on my side. I am backing my numbers with the disposal of resources I have with me. I am having my, I'm having my numbers accounted depending on the management that is going into doing this project. So in all these cases, the revenue numbers which I present in years 1, 2, and 3 are not inflated, rather they are actually recognized. I know it's difficult for us to imagine this concept because what we are used to is, sir, bonus kab milega if you complete the project less than 5 years. आपका guarantee क्या है that you will complete in 5 years, in 4 years? Is there a guarantee? You will say, sir, guarantee is not there, but it is a reliable estimate. When you can do estimate for depreciation, when you can do estimate for provision for bad debts, when you can do estimate for thousand other things, why can you not do an estimate of revenue? First point. Second point, what is the definition of a transaction price under Ind AS 115? Transaction price is the amount expected to receive. So when I say expected to receive, my expectations carry the weight of this revenue numbers. My expectations carry the weight of these revenue numbers. And therefore, the revenue is not inflated, rather it is faithfully represented. Are we able to understand the difference between both of them? Yeah, Shruti, are you able to follow? My revenue I'll not call as inflated. I will call it as a revenue being faithfully represented. The revenue being faithfully represented. Okay. Are you able to follow? Yes. Any conditions to recognize the bonus? The only condition that is there is how much sooner can you recognize the revenue, and what is your supporting working for that? What is your supporting working, your calculations for that? And if those calculations are viewed and you arrive at a conclusion that yes, I can complete it within a time span of 4 years, then at that point of time, you are going to book the revenue at 3,360 crore rupees. Okay. And accordingly apply the percentage of completion. Accordingly apply the percentage of completion. Okay. Any other questions I have? Yes. Vimal, I'm coming to your point on penalties in a short while. Okay. I'm coming on a short while. All right. Now, let us move one step further. Everybody's सबके दिल की बात, मन की बात. Okay, everybody is having what you can say. Everybody is having this question. Sir, suppose contract does not get over in the 4th year. Suppose contract does not get over in the 4th year. Yes, if the contract does not get over in the 4th year, it spills over to the 5th year, and you finish it in the 60th month. That means what? Let us assume year 4 was an abnormal year. Year 4 was an abnormal year. In year 4, COVID happened. In year 4, that black swan event jo tha, COVID happened. And because COVID happened, एक तो ये 3-4 महीने का lockdown. So my laborers were not available, my resources did not reach in time, the supply chain was affected, everything went in chaos. And when everything went in chaos, the next problem that arose is, I'm not meeting the project deadlines. Acha. Those who advocate conservatism, those who follow AS7, they will say, we had told you don't recognize the bonus. We had told you don't book the bonus until you actually finish the project. Ind AS 115 says, agreed. When I say revenue expected to receive, it becomes an estimate. And therefore, in year 4, you do not meet the revenue. You do not meet the job requirements. You do not deliver the goods. Then at that point of time, what should be the revenue that you should be booking? Then, suppose you have been able to complete only 90%, you will then book the revenue as 3,000 into 90%. That means This comes to 2,700. And is this an error? What do you think? Is this an error or is it a change in estimate? Is it an error or is it a change in estimate? Just give me a minute. Yes. So what all of you are saying, it is a change in estimate. Absolutely right. It is a change in estimate. Nobody could think that something like COVID will happen. COVID happened. My estimates went for a toss, and therefore I could complete only 90%. So my revenue to be booked should be 2,700 minus, till last year I had recognized 2,352. So 2,700 minus 2,352, 348 is the revenue that I will be booking. And now, can you explain the reader of financial statements why this happened? Answer is yes. I have reasons to give why my revenue has dropped to 3,000 crores, why it should not be 360 crores bonus. Why did I have to de-recognize it? And in the fifth year, you book 100%. So 3,000 into 100% is equal to rupees 3,000 minus, you had booked 2,700 earlier. So that gives you rupees 300 crores. That gives you rupees 300 crores. Okay. So this is how you do the accounting. Now there can be thousands of permutation combinations here. Suppose you say, okay, so this is a construction of a bridge. It's a huge bridge. So currently what I'm going to do is, year one, let us see how the contract progresses. So I'm not sure whether I'll be able to complete it within 4 years, within 5 years, within 3 years, whatever it is. So first year, let me just take that. I will take the full contract span of 5 years to complete. So in year one, 3,000 crores will be your estimate, and you recognize the revenue at 3,000 crores. Now, year two progresses and you notice that the job is coming out faster than you believe. Now you are getting the feeling that ye contract I can do it within 4-year period. That means I am going to get a benefit of 12 into 30, that is 360 crores. In year two, you recognize the bonus. In year two, you recognize the revenue inclusive of the bonus. Yes. So all these things you can definitely work around. Okay. Some may say year 1 and 2 hum log dekhenge. Year 3 we will come to know the actual picture. So you can start to recognize the bonus in the third year itself. And then fourth, and then that is how you are going to do. So this is how you are going to proceed with the recognition of the revenue. Okay. So to summarize, let us look at how the variable consideration will be recorded. Okay. See, At the inception of the contract, you are going to determine how much revenue will I receive for my particular performance obligation. When I say receive, expect to receive, it means a fair value. It means an estimate. It means a number based on your judgment of your own performance. So that is what you are going to do. So in our example, I feel that I'm going to complete the contract within a span of 4 years. I don't need 5 years. That means you will be completing 12 months prior. You will be completing it 12 months prior to your scheduled completion date. So you believe that 360 crores is the bonus that you are definitely going to get. So 3000 plus 360, 3,360 crore is the contract price for you. So in years 1, 2 and 3, you do the booking based on 3,360 crores. Now in year 4, if you complete the project, 3,360 into 100%, you do the accounting accordingly. But suppose we come to these years, 4 and 5. Now, in the 4th year, COVID happened. And because COVID happened, work was stopped, workers were not available, supply chain management was affected, material was not reaching to the company on time, okay? And we had a host of other issues, okay? So therefore, in the 4th year, I realized that, yeah, before this month end, I'm not going to get the bonus. I'm not going to finish this project before the end of the 4th year. ये जाएगा 5th year में, and entire 5 years it is going to entire 5 years, that means entire 5th year is going to go for getting the completion of this project pura. And therefore in year 4, assuming that you have completed 90% of the work, 3,000 crore only will be the revenue number that you are going to recognize. Why? Because now you believe that I'm not going to meet the requirements, and therefore we are going ahead and doing the a recognition at 3,000 crores. Yes. So 3,000 into 90%, 2,700 minus 2,352, that gives you 348 crores. And then year 5, when you actually complete, it will be 3,000 into 100%. So basically, you end up with 300 crores. Are we clear with this? Yes. Did you understand, Shankar? Did you understand, Yedu? हेलो चल रहा है अभी? Okay. Sorry guys, there was some technical issue from the broadcasting team. Are you able to listen now? Yes, are you able to see? Vimal, Vanshika, Tanisha, Mohammed, are you able to view now? There was some technical issue from the broadcasting side. Okay, all right. So now let us continue. Okay. So suppose there was a query that, sir, suppose if we complete it within 4.5 years, if it comes within 4.5 years, instead of 4 years as planned, then do I have to do the change? Yes, you make the change. So in year 5, you are not able to complete the job at the end of year 4. At the end of year 4, you estimate that you will complete, but you are not able to complete. So at the end of year 4, I know how much I'm going to complete, when I'm going to complete. And that is why in year 4 itself, you will now say that, sir, I'm not going to get the full bonus. I'm going to get only 6-month bonus. So 30 into 6 months, 180 crores. So in year 4, you will now say that I'm not able to complete it. So 3,180 into 90%. So this is Aditya's query. So 3,180, 3,180 into 90%. You will book a revenue of 2,862 cumulatively minus 2,352 minus 2,000 will be 3,180 into 100%, 3,180 minus 2,862. So 3,180 minus 2,862, you will book a revenue of 318 crores. Are we clear with how the variable consideration is going to get accounted? Yes. Mohammed, please confirm. Is your video coming proper now? Yes. Others also, please, they have confirmed. Yes. Okay. So basically, we are looking at how faithfully I represent my revenue numbers. Being ultra conservative, being extremely conservative is not faithful representation. It is actually going to border on the misrepresentation category because you have not done that job. You have not done it. Okay. So therefore, you are going to recognize on a realistic basis. Okay. Now, everybody will have another doubt. Yes, though you have not asked it. Sir ने तो बोला, sir ने कहा, do not be conservative. Sir, you are giving an open invitation for inflating the revenue. Yes, आप खुली छूट दे रहे हो सबको, भाई recognize करो revenue. Yes, you are now saying that you are giving everybody open invitation. Ind AS 115 is telling include variable consideration. So we'll include the bonus from our initial estimate and then we do the change later on. Sir, suppose the CEO is having an incentive based on revenue, then the CEO will be dancing with joy at this kind of a treatment. He will say, "ठीक है यार, inflate the revenue, we will present an estimate." So that is how, that is what Ind AS 115 says is what may be going on in many of your thought processes. But Ind AS 115 tells, wait for some time. We have conditions attached to this. So now my transaction price comprises of two things. One is fixed consideration and the other is variable consideration. Fixed consideration always included in transaction price. That means in our example, this was 3,000 crores. This is always going to remain. This is always going to come to you. So you have to include it in the transaction price. Okay. Assuming your percentage of completion method is allowed under Ind AS 115, we have special revenue models which we will hopefully be able to see in the next class. We have multiple revenue models. One of them is revenue recognized over a period of time. So how to recognize, we will look into that. But assuming for the time being that percentage completion is the basis for recognizing the revenue, then this 3,000 crores you will definitely recognize on the basis of your what you can say degree of completion. ये तो है always included. When you come to variable consideration, the standard gives two guidelines. You have to check whether the variable consideration is subjected to constraints. And on the other side, you have to estimate you have to see whether the variable consideration is not subjected to constraints. Not subjected to constraints. Constraints means what? Constraint means any obstacle, any hurdle, any impediment, anything that comes between you and fulfilling the performance obligation in the time span determined by you. If there is no constraint, include variable consideration in transaction price. Include variable consideration in transaction price. But suppose if the variable consideration is subjected to constraints. If it is subjected to constraints, it means that significant probability of reversal of revenue exists. Significant probability of reversal of revenue exists. Suppose you are not L&T. Suppose it is some local entity, okay, small entity who got a 3,000 crore contract. And now it wants to recognize the revenue. It also believes it can complete it within 4 years. But unfortunately for this entity, this contract of a similar size, similar complexities, similar similar revenues, etc. This is the first contract that has come to the entity. This is the first such contract that has come to the entity. The entity has no prior experience of such a huge contract. It is doing small contracts, matlab 1 kilometer road constructed, half a kilometer road constructed. Somewhere dam had some technical faults, it went and repaired the dam. So it did not have an end-to-end project construction experience. That means if this entity says it will complete the project within 4 years, if this entity says it can complete the project within 4 years, are you going to rely on such an entity's statements as an auditor? Suppose you go as an auditor of this entity, जिसका कोई background experience नहीं, no experience of doing such heavy projects. Are you going to rely on this entity statement that yes, we can complete the project? Will you rely, or will you say, no, I don't rely on your job? Will you rely or will you not rely? Come on, tell me. It will match, Rajiv. It will match. I will take you through that. Come on. Suppose you have this new entity that received the contract. The new entity says 4 years. Will you rely on that, or will you say we will wait and watch? You will not rely. You should not rely ideally. If you are a strict auditor, which is very much required in these times, then you will not rely. You will not rely. You should not rely. If you do not rely, what are you saying? You are saying, understand this carefully. See, entity says it can complete the job within 4 years. Entity is saying it can complete the job within 4 years. That means the entity wants to recognize a revenue of 3,360 crores. It wants to recognize a revenue of 3,360 crores. Now, if it wants to recognize a revenue of 3,360 crores, there must be a strong basis for completing the contract within 4 years. You as auditor will obviously say, sir, हमको तो नहीं दिखता है. We do not see this. If you do not see this, what will happen is a entity most likely will not complete the contract within 4 years. But based on its estimates, it would have booked 3,360 crores at the end of 4 years. That means what will happen is in the fifth year, there will end up being a reversal of up to 360 crores. It will end up being a 360 crore reversal. So when we say that a variable consideration is subjected to constraints, it means that by virtue of whatever reasons, if I have estimated a faster project completion rate to get the benefit of bonus accounted in my financial statements, then there is a likelihood that such bonus will never be realized, and in the last year, you will end up reversing the revenue. Revenue reversals are extremely suspicious. It's not nice to have a negative revenue in your profit and loss account. Okay. It's not right. It should not be the case either. And therefore, if my variable consideration is subjected to constraints, it means only one thing. There is a significant probability that the revenue which you recognize today could end up getting reversed in the future. And because it ends up getting reversed in the future, will you include variable consideration in the transaction price? Answer is no. Variable consideration not included in transaction price. Not included is transaction price. So what are the natures of subjected to constraints? First one, limited experience. And second one is where variable consideration outside the entity's scope. Okay. Example, market-based bonus. For example, you have an entity which says that we are going to give you a bonus if our share price increases by so much. Do you have any say in that particular condition? Answer is no. Answer is, I do not have any control over how the market will end up performing. And therefore, two possible constraints could be, one is limited experience, and the second is where variable consideration is outside the entity scope. Then also you will not include it as a part of your variable consideration. Are we clear with this? Yes. Are we clear? Anybody has any doubt so far? No, sir. Yes, sir. No, sir. Okay. All right. So that takes care of the first part. Acha. What is the benefit of this form of accounting? The benefit of this form of accounting is that my revenues and the profit and loss ends up smoothening out. Nahi to what used to happen? I had recognized the entire 360 crores in year 4 when I had recorded. Okay. I had done the entire booking, and suddenly there is an offshoot in my revenue figures in the 4th year. because I completed the project. Now, that is something which is not good for the reader of financial statements. Whenever you analyze the P&L, you look at the previous period and see the trends. In this case, the trends are not going to come correctly because the profits are not smoothened out. Because the profits are not smoothened out. Okay. Now, we are going towards smoothening my profits over the contract tenure, which is correct, and we have to achieve that, because basically what you are doing is you are providing one contract only to the customer. And if you are providing a single contract to the customer, you are working uniformly on that contract. And if you are working uniformly on that contract, when I say uniformly, I don't mean 20, 20, 20, 20, 20. It could be 10, 40, 30, 20, 10, 25, whatever it is. But what is important is the revenue also moves in the same wave as that of the percentage of completion. That is what I mean by smooth movement in your revenue and consequently in the profits that you are recognizing from the contract. In the profits you are recognizing from the contract. Are you okay? Yes. So we are achieving a smoothening of my profit and loss account. We are achieving a smoothening of my profit and loss account, which otherwise was not being done. Okay. So that takes care of the first part. Now, do we meet? Are we in a position to match what we actually get? Yes, we are in a position to match what we are actually recovering from the contract. So suppose I'll give you 3 instances, over 3 to 4 instances where we actually end up matching what we get. Okay, year 1, 2, 3, 4. Okay, year 1, 2, 3, 4, 5. Contract revenue. Okay. Acha, you got it matched? Okay, fine. But anyways, I'm doing it, so let me do it. So 3,360 into 10%. I get 336 into 50%. My cumulative revenue ends up being 1,680. Cumulative. 3,360 into 70%. So that gives you 2,352. And then 3,360 into 100%. 3,360. 3,360. And this is the amount that you are going to recover from the customer, because you submitted the bridge to the government department in the last month of 4th year. So 3,360 is what you are going to get. Okay. So this is the contract revenue booked on a cumulative basis. Suppose this changes and you are unable to complete it within 4 years and you take 4.5 years, then what will happen is you will book here 3,180 into, let us say 90%. Let us say 90%, because you have been unable to complete that. So 3,180 into 90%. 2,862. And last May 3,180 into 100%. So that gives you 3,180. And you are going to recover also 3,180. So all this matches with the contracted revenues that you are expected to realize. Are we okay with this? Yes. Are we okay? Now, the next query that arises is, sir, variable consideration will always be positive only. Can it be negative? Definitely it can be negative. Penalties. Sir, 5 months years के बाद if you end up submitting the if you end up constructing and you do not complete it within 5 years, then for every month after 5 years we are going to what you can say, levy a penalty on Larsen and Toubro. We are going to levy a penalty on Larsen and Toubro. And if we are going to levy the penalty, then I should have a mechanism of estimating how much can I extend my contract? How much can I extend my contract beyond the 5-year gap? Beyond the 5-year tenure, sorry. Okay. So suppose L&T says we will be taking 5 years plus 3 months. We will be taking 5 years plus 3 months. So therefore, what will happen is, we are going to take the variable consideration as negative 30 crores into 3 months delay. So this gives me minus 90 crores. Therefore, total revenue is equal to rupees 3000 crores minus rupees 90 crores. So this gives you 3000 minus 90 gives you how much? 3000 minus 90 gives you how much? 2,910 crores. And this 2,910 crores is going to be the basis for your this is going to be the basis for your accounting. This is going to be the basis for your accounting. Okay. All right. So you are having penalties also. So ultimately, when we talk about penalties, it's classified into two types. Okay. What are those two types? All my penalties go under either transactional penalty and the other side is protective penalties. When I say transaction related penalty, it is like a penalty for not completing work on time. Example, penalty for not completing projects punctually. Penalties for not completing the projects punctually is one of the example. That means what? That means since this is related to your performance, related to your output, therefore, ultimately what will happen is, therefore, you are going to take this particular thing as a variable consideration, So this is included within scope of consideration. Under Ind AS 115. The other set of penalties are what are my protective penalties. Suppose you have given your property on lease, and then the lease tenure ended, you did not want to renew, so you call that person and say that we want the what you can say, we want the property vacated because we want to use the same. We want to use the same. And therefore, when we talk about protective penalties, they are meant only for protecting your rights. Only for safeguarding position of the only for safeguarding the position of the seller. It's not transactional. I repeat, it's not transactional. Since not transactional, comma, not included within scope of consideration under Ind AS 115. Under Ind AS 115. Protective penalties are only meant for protecting your position. They are in no way connected with a transaction, and therefore that will not be reduced. That will not be reduced. What will reduce is penalty for non-completing the payables, not completing the projects punctually. Not completing the projects punctually. This is purely related to the transactions that you are entering into. And because you are entering into a contract for transactions, take it as a part of variable consideration. Sir, how is protective penalty levied? See, it is a normal kind of penalty. Like, for example, your lease tenants. You need the property, so you are telling them to vacate, and they are not, they are saying that it will take some time. So you say that for every day that you stay on my property, I'm going to recover 1,000 rupees from you. That particular activity, that particular thing is what is your protective penalties, is what is your protective penalties. You want to safeguard your position. You want to safeguard your position. And that is why you are entering into such contracts. Okay. It is in no way linked to your revenue. It is in no way linked to your revenue, and hence, Ind AS 115 will not apply in the case of protective penalties. Are we clear with this? Yes. Are we clear? Any doubts, anybody? Yes. Bolo. Please tell me, have you understood after talking so much on a Sunday morning when otherwise you would be able to sleep freely? You came to the morning and saw the discussion. Are you able to understand variable consideration now? Are you able to understand variable consideration now? Yes? Yes? Okay, Mofita has confirmed. Manan has confirmed. Shankar has confirmed. I think Rajiv, Vanshika also have confirmed. Vimal has confirmed. Okay, so now we come to questions. We now come to questions. Okay, so we start off with okay. All right. Example of protective penalties, I told you. You tell your tenant to leave, otherwise you will be charging 5,000 rupees per day. After the end of the lease contract, you tell him to leave, but he is not leaving, so you start levying a penalty of 5,000 rupees per day. We call that as a protective penalty. We call that as a protective penalty. Okay. All right. Yes. I want you to go through illustration number 29 right now. I want you to go through illustration number 29 right now. Okay. And see whether you can solve it. And see whether you can solve it. Okay. Vimal has asked 2 questions on penalties. Correct, Vimal. So what you have asked is, I think, price reduction within 6 months, after 5 years, 10%. So you have to estimate in a similar manner. You have to estimate, if you believe you are taking more than 5 years, then in what slab are you fitting? Are you going to deliver it within a span of 6 months after 5 years? Then you factor that 10% penalty in your variable consideration. If you think it will take 6 to 9 months and that gives you 20% penalty, then you take that 20% in your what you can say, you take that 20% in your variable consideration. If you take more than 9 months, then penalty of 40%, take that 40% into your variable consideration. Okay, so that is normal. Anything else you had asked? Okay. In case of fixed consideration also, agreement is having a price reduction clause. Then even rupees 3,000 crores can be rupees 2,500 crores in contract as well. I did not understand this question in the respect of the penalty. Please elaborate this particular question. Okay. All right. Others, are you reading this question? Yes. Are you reading this question? Yes. Are you able to understand the question? I'll give the break later. It's too early to give a break. It's not even 8:30. Okay. All right. XYZ enters into a contract with a customer to build a sophisticated machinery. The promise to transfer the asset is a performance obligation that is satisfied over time. The promised consideration is 2.5 crores, but that amount will be reduced or increased depending on the timing of completion of the asset. For each day after 31st March that the asset is incomplete, the promised consideration is reduced by 1 lakh. For each day before 31st March that the asset is complete, the promised consideration increases by 1 lakh. Okay. Now, this particular thing, you just keep it aside for now. Though you have read it, I will explain one concept shortly. Determine the transaction price. So how do you go about? Well, you will estimate what is the time taken to complete the contract. If the variable consideration, what is the variable consideration in this contract? 1 lakh per day. If the variable consideration is not subjected to constraints, will I include it in my transaction price? Answer is yes. So therefore, you have to check whether you are going to include this as a part of your transaction price. So your estimates will matter. In how many days are you going to complete the contract? What is the variable consideration which you can include as a part of the transaction price for the purposes of accounting for revenue as per Ind AS 115. So here there is no defined figure given. It is more of a case study based approach. It is more of a case study based approach. Okay. So this 1 lakh per day, not subjected to constraint, include in transaction price. Include in transaction price. Okay, very simple. Okay, I have a question. Sometime in the contract, we might have a clause, if the work is completed by 2026, for example, price is 3,000 crores. If work is completed by 2027, price would be 2,500 crores. Or sometimes agreement says work would be completed by third party and any cost incurred by the third party would be reduced from the consideration payable. Okay. So now you are asking, how will this impact my revenue recognition? See, first point. Contract to be completed by 2026 or by 2027, as the case may be, you have to estimate this at the inception of the contract, which is what I have told you in my example since today morning. And based on that estimate, your revenue will be either 3,000 crores or 2,500 crores, and you do the accounting accordingly. Now, considering the fact that sometimes agreement will mention that where the work is to be completed by a third party, any cost incurred by the third party would be reduced from the consideration payable. That means I'm trying to assume that the contract is half done by the original contractor, and then somebody else comes to complete it and you have to pay it off. Just confirm if that is what you are trying to tell, so that we can discuss on that. Okay. Now, the next question that arises is, how to estimate variable consideration. How to estimate variable consideration. So there are two approaches to this. First approach is expected value method. Expected value method. The other one is most likely method. Most likely method. Okay. So when you say expected value method, it means a weighted average probability approach. Weighted average probability approach. So like in our example, bonus was 30 crores. Yes. if you complete within 1 year, 60 crores if you complete within 2 years, 90 crores if you complete within 3 years, 120 crores if you complete it within, it's the opposite way, okay? When I say 30 crores, job is completed within 4 years, 60 within 3 years, 90 within 2 years, and 120 crores within a span of 1 year. So now you can assign a probability to this. You can now assign a probability to this. There is a 40% chance I will complete it in 4 years. A 30% chance I'll complete it in 3 years. A 20% chance I'll complete it in 2 years. A 10% chance I will complete it in 1 year. And therefore, the weighted average now looks something like this. This is 12, this is 18, this is 18, and this is again 12. So this comes to 60. And 60 is the basis for doing your recognition. 60 is the figure that goes into your revenue recognition. 60 is the figure that you will recognize as a revenue, as your variable consideration that goes in the revenue. So this will be part of your transaction price. What is the advantage of this method? It analyzes multiple scenarios. And by analyzing multiple scenarios, it arrives at a particular number which could probably go into your transaction price. The drawback of this is it need not always give the same bonus figures. The bonus figures could change because the probabilities could also end up being different. But nevertheless, this is one of the methods where your probabilities of completing the project are mutually exclusive. Okay, are mutually exclusive. If you complete within 4 years, you will not be completing within 3 years. If you complete within 3 years, you will not be completing within 2 or within 4 years. If you complete within 1 year, you are not completing within 2, 3, 4 or 5 years. So they are mutually exclusive. Therefore, the probabilities of all the possibilities you estimate and arrive at my expected value. That expected value, in this case it is 60, will go as your variable consideration in the transaction price. When I talk about most likely method, only two options exist. And what are those two options? Can I fulfill or can I not fulfill? Can I fulfill or can I not fulfill? That means what? That means probability of fulfilling, if it is more than 50%, then you straight away take that as your variable consideration, whatever that amount is. And if it is less than the 50% criteria, it will not be considered in the revenue. Are we clear with the two approaches? Yes. For example, product should qualify quality test, quality control test by customer. Product should qualify the quality control test by the customer. So there are only two options. Either it qualifies or it does not qualify. बीच में कोई रास्ता नहीं है. Okay, sir, 40% it will qualify, 30%, 20%. नहीं. It's either all qualify or all do not qualify. Okay, just two options. So whatever probability is higher, that is going to sit as your variable consideration in the transaction price. Okay, so this is Most likely method. So for estimating variable consideration, you can use either of these two approaches. Either expected value method, where multiple scenarios can be assessed, can be judged, or on the most likely method, where it is only either this way or that way. There is no third option available. Okay. So either you comply or you do not comply. Okay. But okay, either you comply or you do not comply. That is what you can do it. Okay. So now the problem is, how do I understand that I will meet the quality standards that the customer levies? Yeah, that is obviously a job which you are doing for quite some time, right? That is how much, that is the job which you are doing for some of the time, right? So you will obviously know whether you meet the quality assurance requirements of the customer or not. Yes or no? If I am entering into a contract to supply some electronic equipment to be used in defense equipment, okay, like I'm providing a dashboard for the war tanks, I have stringent requirements of the defense, but I know now whether I'm meeting that requirements or not. What do you think? I know whether I'm meeting the requirements or not. And when do I know this? I will know this at the inception of the contract, because they will give you the indicators of quality. They will give you the indicators of quality. So you definitely know whether you are meeting or whether you are not meeting. Is it okay? Yes. Are you able to understand both of them? Yes. Expected value method, and the next one is most likely method. Most likely method. Okay. Now let us look at this particular question. In addition, upon completion of the contract, a third party will inspect the asset. A third party will inspect the asset and assign a rating based on metrics that are defined in the contract. If the asset receives a specified rating, the entity will be entitled to an incentive bonus of rupees 15 lakhs. Determine the transaction price. Determine the transaction price. So this one is going to be an expected value approach. Expected value approach. And this meeting the metrics is going to be most likely approach. Most likely approach. Are we clear with this? Yes. Are we clear with this? Yes or no? So at the beginning of the contract, how many days prior or afterwards you are going to take care? You have to ensure that it is done. And the meeting of the metrics requirement, it's either yes or either no. So you just do the assessment accordingly. You just do the assessment accordingly. Are we clear with this? Yes. 29 is done. 29 is done. Yes. Anybody has any doubts? Vimal, did you understand how do we know at inception of the contract? Yes. Yes. All right. Please go through illustration 30. Please go through illustration 30. See, AST enters into a contract with a customer to build a manufacturing facility. Entity determines that the contract contains one performance obligation to be satisfied over time. Construction is scheduled to be completed by the end of the 36th month for an agreed upon price of rupees 25 crore. The entity has the opportunity to earn a performance bonus for early completion as follows. 15% bonus of the contract price if completed by the 30th month. 10% bonus if it is completed by the 32nd month with a 40% likelihood, and 5% bonus if completed by the 34th month with a 15% likelihood. In addition to the potential performance bonus for early completion, AST is entitled to a quality bonus of 2 crores if a health and safety inspector assigns his facility a gold star rating as defined by the agency in the terms of the contract. AST Limited concludes that it is 60% likely that it will receive the quality bonus. Determine the transaction price. Determine the transaction price. Determine the transaction bonus. Dekho, what do you think of this 25 crores? Is it fixed or is it variable? This 25 crores, is it fixed or is it variable? Fixed. Yes. All right. So if this is fixed, this will obviously go and sit as a part of your transaction price. So no doubt about this. So this part is done. Now the entity has the opportunity to earn a performance bonus for early completion as follows. 15% of the contracted price. That means 25 into 15%, 3.75. 3.75. For what is the probability? Probability of this is 25%. Probability of this is 25%. You are likely to get a 10% bonus. So 25 into 10%, that means you are likely to get a 2.5 crore business if completed by the second month with a 40% likelihood. With a 40% likelihood. Okay. And then the last one is 5% bonus. 5% bonus means 1.25. 1.25. Am I right? And what is the probability of this? 15%. The probability of this is 15%. Look at the probability: 25 plus 40, 65 plus 15, 80%. It should be 100, right? So there is another 20% for which you are having no requirements. No requirements. Okay. So therefore it's kept as 0. So now expected value 3.75 into 20%, 20 or 25%, 3.75 into 25%, I get 0.9375. 2.5 into 40%, 1 crore. 1.25 into 15%, so that gives you 0.1875. Are you guys solving? And then the last one is 0. So 0.9375 plus 1 plus 1.1875. 2.125 is the bonus that you can include it in the transaction price if they are not listed to, if if they are not subjected to constraints. If they are not subjected to constraints. Are we clear with this? Yes. The remaining 2 crore is a quality bonus if the health inspector gives certificate. So it is either 2 crores or a quality bonus of 2 crores, or it could end up being this is either complied or not complied. Okay, so have they given what will happen? Concludes that it is 60% likely it will receive the quality bonus. So therefore, based on that, the variable consideration is 2 crores. So therefore, total transaction price is equal to 2 crores plus 25 crores. So that gives you 29.125 crores. That gives you 29.125 crores. Are we clear with this question? Yes. Are we clear? Yes. Everybody, did you understand illustration 30? Did you understand illustration 30? This is expected value, whereas this one is regular. All right, absolutely clear. Very happy. Yes, so that completes the first part. That completes the first part. Let us see what is there in illustration 31. Okay, we'll do the next set of questions after a short break. It's 8:50 almost. We resume at 9. We resume at 9. We take a 10-minute break. I'll extend the session a little bit today also. I was planning to complete steps 3 and 4, but it looks like only step number 3 will be completed today. Okay, because it's taking time. It's taking time. Let us see. Okay, this is the biggest one. Significant financing component is a short one in that regard. Okay, so the remaining ones are small. Let us have a look later on. Okay, all right. We resume at 9. It's 8:50 now. 10 minutes break. Okay. Acha, I had two queries in the previous question. In the case of quality bonus of 2 crores, why the amount is not multiplied with 60%? Very simple, yaar. See, quality bonus is assigned by a health and safety inspector. The health and safety inspector may either assign or not assign. Only two options are there. Remember, I had told you how to estimate variable consideration. You can follow expected value method or you can follow most likely method. In the case of this question, where the performance bonus is there, we can apply expected value method because multiple scenarios are possible. But when I talk about the health inspector approach, when I talk about the health inspector's certificate or his rating, the rating can either be given or not given. Can he say, I'll give 40% rating, 30% estimate, 20%, 10%? I cannot. So therefore, here there is a 60% possibility that I will get the revenue and that I will get the rating. Since there is a likelihood I will get the rating, I get the rating means I get the revenue of 2 crores. As simple as that. Here there is no weighted average expected value. If you get the rating, you get 2 crores. The probability of you getting rating is 60%. You cannot do 2 into 60% because you are not getting 1.2. You will get 2 only. Since your probability of getting the rating is more than 50%, it is more likely than not that you will get the rating. And therefore, we recognize entire 2 crores as the estimated transaction price, as the expected transaction price. Are we okay with this? Yes. Are we okay? Any doubts? Any doubts so far? Yes. Anybody has any doubts? Rajiv, is it clear for you, beta? Aditya, is it clear? Yes. Clear, not clear, understood, not understood? Okay, all right. So I'll wait for your response. Let us move on to illustration 31. HT Limited enters into a contract with a customer to sell product X for 1000 per unit. If the customer purchases more than 100 units of product A in a financial year, the contract specifies that the price per unit is retrospectively reduced to 900 per unit. Consequently, the consideration in the contract is variable. For the first quarter, the entity sells 10 units of product A to the customer. The entity estimates that the customer's purchases will not exceed the 100 unit threshold required for the volume discount in the financial year. HT Limited determines that it has significant experience with this product and with the purchasing pattern of the customer. Thus, HT Limited concludes that it is highly probable that a significant reversal in the cumulative amount of revenue recognized will not occur when the uncertainty is resolved. When the uncertainty is resolved. That is when the total amount of purchases is known. Further, in May X1, the customer acquires another company. And in the second quarter ended 30th September, the entity sells additionally 50 units of product A to the customer. In light of the new fact, the entity estimates that the customer's purchases will exceed the 100 unit threshold for the financial year, and therefore it will be required to reduce retrospectively the price per unit to rupees 900. Determine the amount of revenue to be recognized by HT Limited for the quarter ended 30th June 20x1 and 30th September 20x1. All right. So now tell me, correct. That's right, Vimal. Okay. So in that performance basis, if you are getting 1-star rating, you get some bonus. 2-star rating, you get some bonus. 3-star rating, you get some bonus. 4-star, you get some bonus. 5-star, you get some bonus. Then you are going to do the expected value of method. That's right. That's right. Okay. All right. Now let us come to illustration 31. Okay. Up to 100 units, selling price is equal to rupees 1000 per unit. Am I right? Yes. If you purchase greater than 100 units, selling price is equal to rupees 900 per unit retrospectively. Retrospectively. All right. So now, do I have a variable consideration here? Do I have a variable consideration here? Yes. I want you to tell me what is the variable consideration in this particular case. If I sell up to 100 units of product A, I am getting 1000. If I sell more than 100 units, my selling price will be 900 per unit retrospectively. So therefore, I want you to tell me what is the variable component in this example or in this illustration. What is the variable component? Minus 100, plus 100, 900, 1000, what is variable? What is variable? Rajiv is right. Vimal is also right. I'm waiting for other answers. Tanisha, Vanshika, Manan, Mohammed, Mufita, Shruti. Pooja is not attending. She was there for the first two classes. Shailesh, Manish, Shankar, Deepak, give me your answers. There were some couple of new students who were there who had responded today. Saravanan, give me your answer. Yadu, give me your answer. Okay. 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 All right. Your variable consideration is 100 rupees per unit. Your fixed consideration is 900 per unit, as simple as that. Whether you sell less than 100 or whether you sell more than 100, what you are getting is 900 guaranteed. What you are getting is 900 guaranteed. The remaining 100 ends up to be a variable consideration. It is not 1000 fixed and minus 100 variable. It is 900 fixed plus 100 variable. So my transaction price looks something like this. Okay. Fixed, variable. Whether you sell up to 100 or beyond 100, 900 तो आपको guaranteed है. So 900 is fixed. This will always be included in the transaction price. The variable component is rupees 100 per unit. Whether to include it in the transaction price or not, we will have to see. So for that purposes, we will have to evaluate whether it is subjected to constraint or not subjected to constraint. So if it is constrained, exclude from transaction price. And if it is not constrained, include in transaction price. Include in transaction price. Okay, I hope you guys note down these things, whatever I mention. Okay, I hope you guys note down these things, whatever I mention. Okay. Okay, so now let us look at the question. What is it saying? For the first quarter ended 30th June, 10 units are sold. Entity estimates purchases won't exceed 100 units for the volume discount. It has significant experience with the purchasing pattern of the customer, and therefore this term that a reversal of revenue will not occur, basically it is saying that this is not constrained. This is not constrained. And therefore, what are you going to do is, for the quarter ended 30th June 20x1, for the quarter ended 30th June x1, is that 100 rupees consideration constrained? Answer is no, it is not constrained. And because it is not constrained, you will include it in the transaction price. Okay, so not constrained, because he knows the pattern, he knows all those things. So therefore the revenue is, the variable consideration is not subjected to constraints. Therefore revenue is equal to 10 units into 900 plus 100. 900 plus 100. So that becomes 10,000. That becomes 10,000. All right. So this is the quarter ended 30th June. For the quarter ended 30th September, now what has happened? There has been a business combination. The customer acquires another company, and in the second quarter, the entity sells additional 50 units to the customer. My customer acquired another entity, so therefore his requirement has gone up. And because his requirement has gone up, he has asked us for 50 units. And now I am starting to feel the heat. I am starting to say, look, his requirements have increased, so we will now probably end up crossing 100 units during the year. And therefore, the revenue should be at the rate of 900. The revenue should be at the rate of 900. So this is going to be constrained. This is going to be constrained. So therefore, 50 units into 900. 45,000. But wait a minute. The variable consideration of 100 will be eliminated prospectively or retrospectively? What do you think? The consideration will be eliminated prospectively or retrospectively? They have given retrospectively, right? What they have told, if the customer purchases more than 100 units, then the contract price per unit is retrospectively reduced to 900. So therefore, I have to also recognize a revenue reversal. I have to also recognize a revenue reversal. How many units? 10 units into rupees 100. So that gives you 1,000. That gives you 1,000. So 45 minus 1, the revenue that you will recognize is 44,000. The revenue that you are expected to recognize is 44,000. Are you clear with this? Yes. Are we clear with this question? Yes. Okay. Yes. Okay. Yadu has confirmed. Mufita, Vimal, Shankar. Yes. So that is done. So illustration 31 is taken care of. Okay. Now, illustration 33. Illustration 33. On 1st April 20x1, an entity enters into a contract with a client to provide asset management services for 5 years, portfolio management. The entity receives a 2% quarterly management fee based on the client's assets under management at the end of each quarter. At 31st March X2, the client's assets under management are rupees 100 crores. In addition, the entity receives a performance-based incentive fee of 20% of the fund's return in excess of the return of an observable market index over the 5-year period. This is your variable consideration. Okay, this is your variable consideration. Okay. Consequently, both the management fee and the performance fee are variable, obviously, because you are getting a 2% quarterly management fee based on the assets under management. So this also ends up being variable. Analyze the revenue to be recognized on 31st March 20X2. Analyze the revenue to be recognized on 31st March 20X2. What do you think? Should it be 2 crores? Should it include that 20%? Should it not include that 20%? Should it not even be 2 crores? What do you think should be the revenue? What do you think should be the revenue? What do you think should be the revenue? Should it be 2 crores? Should it be with that bonus of 20%? Yes? Yes. Manan gave the answer. What about the other? Shruti, Tanisha, Vanshika, Shankar, Rajiv, Aditya, Sarvanan, Deepak, Yadu. What do you think should be the revenue? Okay. Manish, you are sure you have typed the right number? It should be only 2 crore rupees. It should be only 2 crores. You cannot recognize 20 crores, as Yadu has rightly mentioned. You cannot recognize that 20% because it is a market-based bonus. It is a market-based bonus. Market hamare mutti mein nahi hai. I am not the one who can correctly estimate how the market is going to respond, and therefore we cannot have that much also degree of estimation where things are not at all in our control. See, the contract that L&T had in the earlier question that we did, the contract of L&T that we had, we are going to, we could take the estimate there because that was dependent on L&T's own performance. Here, the bonus of 20% depends on the market performance, which is not in my control. And therefore, I cannot recognize that as a variable consideration to include in the transaction price. It is variable consideration, but I cannot take it as my transaction price because it is severely constrained in the sense that it is market related, and market related hone ki wajah se I cannot have any say in that regard. Is it okay? Yes. So 2 crores for this. Manish, it won't be 2 crores per quarter because next quarter the assets under management could change. So therefore 2 crores is adequate. 2 crores is adequate. Okay. All right. Next, let us proceed to the next understanding. Okay. There are two small concepts. One is, so we are done with variable consideration. What all is to be included, what should not be included, everything is done. So what is variable consideration? Essentially, your consideration is not fixed. There could be a fixed element, there could be a variable element, there could be only variable element, there could be only fixed element. So when we talk about consideration, the fixed portion of the consideration will obviously form part of the transaction price. The variable consideration will also form a part of the transaction price if the variable consideration is not subjected to any constraint. But if the variable consideration is subjected to constraints, what could be the constraints? Having no experience, absence of resources, absence of prior experience to carry out the transactions. If these 3 to 4 conditions are mentioned, then your variable consideration is subjected to constraints, and therefore you will not include this. You will not include this in your transaction price. You will not include it in your transaction price. Also, variable considerations which are dependent on factors other than the entity's control, like for example, the market price. So when you have those kind of variable considerations, they will also not be included because they are also not in control of the entity. So this was by large the most important component of your transaction price. It is for the discussion on transaction price. The first component is complete, that is variable consideration. Under AS9, we never estimated variable consideration because we were following a highly conservative approach. Under Ind AS 115, we are required to estimate it realistically and include it in the estimates of the transaction price. Okay, so that takes care of the variable consideration. Manish, if you see the question, the entity receives a 2% quarterly management fee based on the client's asset under management at the end of each quarter. They have not given us the assets under management on 31st December, 30th September or 30th June. So therefore, we should not rightly assume it to be 100 crores each quarter and say that 2 crore into 4 is going to be your revenue. No, there could be different assets under management for which the amounts would have been different. Okay, so that is done. Let us then move on to the next part, that is warranty services. Okay, the next 2-3 are very small components. They will not take much time. Okay, so warranty offerings. Okay, so now there are two options. You remember that question of the car which we did? Car is sold, warranty is sold, and then servicing is offered. So there, warranty was also sold on a standalone basis. Many cars do that, in fact. If you go to the showroom to buy, they will say, sir, buy 3 years extended warranty, buy 5 years extended warranty, please purchase the warranty. Okay, so they want to offer the warranty as a distinct offering. Okay, so warranty sold as a distinct offering. Warranty is sold as a distinct offering. And if warranty is sold as a distinct offering, remember that example again. Warranty's revenue was recognized as a separate revenue stream. Are you able to recollect? Yes. Have a look here. 13,54,839 was the revenue from the car. 96,774 was the 3-year warranty, because I have a separate warranty stream also. And that is why I could say that we are looking to offer warranty as a distinct offering, and therefore warranty was recognized as a separate revenue stream. In other words, separate warranty revenue, costs accounted on actual, that is accrual basis, recognized on actual basis or accrual basis. So my P&L looks something like this. Just drawing a simple P&L for you to understand. Sales, you will have car, warranty, and servicing. So total gives you the net revenue. Total gives you the net revenue. Against this, you will be having actual costs. Actual costs for the entire period. So naturally, these actual costs that you have, will obviously be incurred to meet the revenue which is recognized on the credit side, Yes. So therefore, these items will be recorded on actual basis. There is no need to maintain a separate warranty provision. Because of this. Alright, so this is the first part. Suppose the opposite happens. What is the opposite? Warranty is not a distinct offering. That means what? You are giving assurance. Assurance is given for the product, but not looking at warranty as a separate revenue stream. Are you clear? Yes. So when this is the case, you are not separating the warranty from the car, because आपका standalone में warranty is not an offering in the first place. What you are selling is, see, in this case, what you are selling is car plus warranty plus servicing. In this case, what you are selling is car including assurance warranty plus servicing. Are you able to follow? Yes or no? Are you able to follow? So therefore, here warranty and car can't be unbundled. Because you don't have a standalone warranty offering in the first place. And because you don't have a standalone offering in the first place, how am I going to allocate on a standalone basis the price to warranty? I cannot. And therefore, warranty and car will not be unbundled. And if it is not going to be unbundled, how will my profit and loss look like? My P&L is going to look like this. I will be having car sale, which includes warranty, and I will be having servicing. So therefore, on the debit side, you tell me now, will I have to book provision for warranty or it is not required? Will I have to book a provision for warranty or it is not required? Think and answer. In the first case, warranty was a separate revenue stream. So you could segregate car warranty servicing separately. And therefore, against these incomes, you had the costs on the debit side, which is adequate. In this case, warranty is not unbundled. So therefore, do you have to make a provision? Answer is yes. We should book on best estimate basis. We should book on best estimate basis. So provision for warranty will come here. Provision for warranty. सर ऐसा क्यों आएगा? अरे आएगा ना, because the car sale includes your warranty here. The car sale includes your warranty here. And because the car sale includes your warranty, the provision for warranty expense has to be recognized separately. And later on, the provision for warranty, the actual expenses will be met out of that provision for warranty. The actual expenses will be met out of that provisions which you are creating each and every year. Is it okay? So that takes care of the warranty aspects. Are you clear? Yes. So that is about warranties. 2-3 छोटे questions हैं. Yes, we will look at those small questions and wind up the discussion on warranty. Then we shall look at the others. Okay. Now illustration 35. Okay. So what is illustration 35? An entity manufactures and sells computers that includes an assurance type warranty for the first 90 days. Assurance type warranty means what? Assurance type warranty means warranty is not unbundled. Warranty is a part of the sale contract for which you will have to make a provision for warranty. Okay, so let us see. An entity manufactures and sells computers that include an assurance type warranty for the first 90 days. The entity offers an optional extended coverage plan under which it will repair or replace any defective part for 3 years from the expiration of the assurance type warranty. That means what is happening? You are selling the product on 1st April 20x1. First 90 days, that means till 30th June 20x1. That means till 30th June 20x1, what you are going to do is, you are going to recognize an assurance warranty, which will not be unbundled from the sale. So this is an assurance type of warranty. And from 30th June, you are giving a 3-year extended coverage. So this goes on till 30th June X1, X2, X2, X3, X3, X4. Now, the first 90 days का जो assurance है, that is an unbundled supply. You cannot separate it from the product. So it will go together as product plus assurance. And then you will have a separate warranty stream. Since the optional extended coverage is sold separately, the entity determines that the 3 years of extended coverage represent a separate performance obligation. Obviously. Total transaction price is 36,000. The standalone prices of the computer and the extended warranty are 32,000 and 4,000 respectively. All right. The inventory value of the computer is 14,400. Further, the entity estimates that based on its experience, it will incur 2,000 in costs to repair defects that arise within the 90-day coverage for the assurance type warranty. So what will be the set of entries that you will pass? First one, we book the sale entry. Bank account debit or trade receivables account debit, 36,000 to revenue. This is the revenue from the computer, so 32,000. And then the warranty is to be spread over 3 years. So that will be a contract liability right now, which will be spread over 3 years, which will be spread over 3 years. Okay, so this is the first part. Second part, what is the entry that will be passed is, the entry that will be passed is for the provision for assurance type of warranty expenses. So warranty expense account debit, warranty expense account debit 2,000 to provision for warranty or to contract warranty. Okay, to provision for warranty 2,000. And then the third entry will be, they have given the cost of inventory also. So you will have COGS account debit, cost of goods sold. Basically, you are recognizing the cost of goods sold. So COGS account debit to inventory. This is going to be 14,400. This is going to be 14,400. So these are the three sets of entries that you will pass. The institute's module, you will refer entries 1 and 2 are clubbed together as a single entry. I just separated it. Okay. Otherwise, it's the same. Otherwise, it is the same. Are we clear with this? Yes. Are we clear? Obviously, you see the whole study material, you cannot redo it entirely. Yes, you cannot redo it entirely. You will be having an this is, most of it is from the old study mat only. Okay, there was a revision that was done at that point of time, what I recollect. So it is a whole copy paste. Though there may be some places where new things are put in. Like for example, if you look at the study material, they have incorporated listed company extracts. They have incorporated listed company extracts so that you can have a look at how the disclosures are actually being done. Somewhere they would have put in some extra problems. Somewhere they would have removed some old problems. But by and large, 90 to 95%, the study mat is remaining the same. In fact, the new syllabus that is there from May 2024, for which these classes are being conducted, FR, there is not much change actually. Okay, it's by and large what has been continuing is going to continue in the future, except I think some 1 or 2 small chapters may have been deleted is what I have a feeling, and conceptual framework has come as a distinct chapter now. So that is the major change which is there. Apart from that, koi khas change nahi hai as such. Okay. All right. I had a general doubt. Why are the years mentioned as 20, X1, X2, X3? Okay. So what could be the reason is, this is my interpretation. One is even foreign exams do this. Okay. ACCA, you can take Institute of Chartered Accountants of England and Wales. They also mention the years as 20X1, 20X2. What happens is, if I mention 2020, 2021, 2022, 2024, what will happen is, the Ministry of Corporate Affairs may notify some accounting standards from a particular date. From a particular date, they may not notify that. Okay, so it is in force for some time. Like this happened with Ind AS 116. Ind AS 116 came somewhere in 2019, I suppose, from 1st April 19. So contracts prior to that were covered under another Ind AS, I think Ind AS 17 or so. So if you put the dates in the actual years 2021, 22, 23, 24, then the possibility is at the time of framing the question, you would be having Ind AS 116 in mind. But probably the dates could go in such a manner that Ind AS 116 was never implemented at that point of time, and the student will end up getting confused in the examination. ये time पे तो Ind AS 116 था नहीं, but the question is asking us on Ind AS 116, and then the student will end up answering Ind AS 17 if he or she has studied, and ultimately it ends up in an adverse scenario for the examiners also, for the students also. So to avoid all such confusion, they are taking generic names, years as 20x1, x2, x3. So with that, what happens is you are not going to look at which Ind AS was applicable at what point of time. What is there in the question is there applicable in the is there applicable for you for that particular time frame. So that is why they have resorted to this, which makes the job very simple for the student also. Student doesn't have to break his brains, and the institute also, the job becomes very transparent. Okay. All right. So now we move on to the next part. We now move on to the next part. 36. Entity sells 100 ultra life batteries for 2000 each and provides the customers with a 5-year guarantee that the batteries will withstand the elements. Withstand the elements means water, rain, winter, वगैरह वगैरह जो भी हमारे 5 elements है, they will withstand those elements and continue to perform to specification. So a 5-year guarantee is given. The entity which normally provides a 1-year guarantee to customer purchasing ultra life batteries determines that years 2 through 5 represent a separate performance obligation. The entity determines that 1,70,000 of the 2 lakh would be allocated to the batteries, 30,000 to the service warranty based on estimated standalone selling prices and a relative selling price allocation. Entity's normal 1-year warranty, the entity's normal 1-year warranty cost is rupees 100 per battery. Pass the required journal entries. Okay. So now we are having batteries which were acquired on 1st April 20x1. Okay. Now, when these batteries were acquired on 1st April 20x1, they come with a 5-year warranty. So x2, x3, x4, x5, x6. Till 31st March x6, you are having the warranty coverage. Out of this, for the first year, till 31st March x2, this is going to be an assurance warranty. They have given in the question, 1-year warranty is normally what is provided, a 1-year guarantee. So this is an assurance. And for years 2 to 5, they represent a separate performance obligation. So warranty obligation is there here separately. And therefore, do I have to split the revenue? Answer is yes. It will be split between the product cost and the 4-year warranty cost for years 2, 3, 4, and 5. And after that, you will do the accounting. The first year's warranty will not be unbundled because it is an assurance type of warranty. It will be included in the product for which you will accrue the provision for warranty expenses. You will accrue the provision for warranty expenses. Is it clear? Yes. All right. So now you are having entry as, just give me a minute, please. Just give me a All right. Sorry to take that call. Okay. So warranty obligation of 4 years will be separate. First year assurance warranty will be included in the product sale, for which warranty costs will be recognized separately. So the entry that you will be passing is uh, bank account debit or debtors account debit, 2 lakhs, to revenue, 1,70,000, to contract liability. This is the 4-year warranty. Years 2 to 5, 30,000. So bank account to revenue to contract liability. And then you will be having the next set of entries, the warranty cost. So warranty expense account debit to provision for warranty. This is based on your best estimates. 1 year warranty cost is 100, sold 100 batteries. So 100 into 100. So that gives you 10,000. That gives you 10,000 rupees. Are we clear with this? Yes. Are we clear with this? Yes. Anybody has any doubts now? Any doubts? Anyone? All clear? Yes. Shall we proceed further? Shall we proceed further? Yes. Okay. All right. You want me to explain once again? Come on. If you have understood the previous one, this is not difficult. Okay. See, I am selling batteries. The batteries come with a 5-year warranty. The entity thinks that the first warranty is an assurance warranty. We are selling additional warranties. That means from years 2 to year 5. So the warranty sale from year 2 to year 5 is a separate performance obligation. You go to buy a car. What is the contract generally telling you? Sir, the car comes with a 1-year warranty for all the mechanical parts and spares. If you want, we can give you an additional warranty of 3 years. The additional warranty is from years 2 to year 5. So therefore, you have an additional warranty of 4 years, years 2 to year 5. That additional warranty is a separate stream of revenue. Together, that means the car, which includes the assurance warranty of 1 year, plus the 4-year warranty, together it comprises of a price of 2 lakh rupees. Now, out of these 2 lakh rupees, the standalone selling prices and allocation tell us that 1,70,000 relates to revenue. And 30 revenue means revenue from sale of the product. And sale of the product will include the assurance warranty. So you are never going to make profit from the warranty sale for the first year. You cannot have a scenario where I buy a car from one showroom A, and I go to showroom B for the first year warranty. Okay, suppose you are buying a Hyundai vehicle from showroom A. You tell him, you give me only the vehicle, I don't want a warranty from you. And you go to the next showroom and tell, I got only the vehicle, give me the first year warranty. Both the showrooms will say, sir, it's not possible. The first year warranty is an assurance warranty. This assurance warranty, we cannot unbundle it from the vehicle. Yes, you want extra warranty, you can take it from us, or you can take it from the other showroom of your choice. So the extended warranty of years 2 to 5 is something which is a separate revenue stream for both the showrooms. And therefore, when you are doing the accounting, the 1,70,000 revenue is nothing but the revenue on sale of the product, which includes the assurance warranty. You are not selling the assurance warranty separately. So therefore, this 1,70,000 comprises of two things. One is the car and the other is the assurance guarantee. One is the car and other is the assurance guarantee. Are we okay with this? Yes, this is the first part. Now, since this first sale of 1,70,000 includes two things. One is the car and the other is the assurance warranty. Car ke liye we have a corresponding cost, that is the cost of goods sold. However, for the assurance warranty, what is the cost? Sir, wo to apne ko malum nahi. You have to make a best estimate of that, for which this 10,000 is going to be recognized. This 10,000 is a provision. Provision for expenses. This is a provision for expenses. In the future, when you incur warranty expenses towards this vehicle, you will meet it out of the provision for warranty account. Okay. You are aware how the warranty accounts function, right? So today I got revenue from warranty, but warranty ka cost today only I am not going to incur. Aage chalke, whenever it is there, I will incur. So until then, I will match a provisional cost to that. So therefore, entry will be warranty account debit to provision for warranty. This is nothing but a expense estimate. This is nothing but estimate of expenses. This provision for warranty. Okay. So first part is clear, revenue is clear, estimation of expenses is clear. So the first part is clear. Now the next part is the warranty. The warranty. The extended warranty years 2 to 5. You can buy it separately from your showroom only or from another showroom. Now when you buy the warranty separately, this warranty represents a separate stream of income, and because it represents a separate stream of income, what is going to happen is that the separate stream of income is going to have its own set of costs, which is booked on an actual basis, accrual basis, for which the revenue is already appearing separately. The contingent liability here of 30,000 represents money received in advance, for the 4-year warranty. Whereas this provision for warranty in the second entry, it represents what? It represents my expenses provision. Both of them are very different. The first contract liability for a 4-year warranty represents money received in advance today, revenue to be recognized over the next 4 years. Whereas the second entry's provision for warranty represents expenses relating to the assurance warranty that you have provided for. So that takes care of illustration 36 in totality. Yes. We now move on to the next part, which is your sale or return. Now, sale or return is extremely commonplace in today's times. It's extremely common. You buy the goods from Amazon. You buy it, you check out those goods, you like it, you keep it, you do not like it, you return it. Okay. Flipkart, Amazon, all these online, and in some brick and mortar stores also you will have sale or return. Now the question is, how do I recognize the revenue on sale or return? How do I recognize my revenue? Do I recognize when order is placed? Do I recognize when order is received? Do I recognize when the waiting period is over? When do you recognize the revenue? Come on, tell me. When do you recognize the revenue? Okay. When do you recognize the revenue? Yes, sale on approval basis. Absolutely right. Okay. Sale or return basis. Okay. So now you tell me, when are you going to recognize the revenue? Arey, performance obligation is done. That I know. When it will be done? Okay. When the return period is over, I got one answer. When order is dispatched, I got another answer. When performance obligation is done is a very generic answer. Please be more specific. Okay. So now let me tell you. Let us make a case study of this, and then you can, okay. All right. Sir, we recognize on dispatch and create a provision for the best estimate on return. Okay. All right. Now, I got various uh, uh, answers. Okay. None of the ladies answered. Okay. Vanshika, Tanisha, what are your views? Mufita, what is your view? And where is Saravanan? Saravanan is not there. Manan has given his answer. Yadu did not answer. Rajiv did not answer. Aditya did not answer. Muhammad did not answer. Tell me, when do you recognize revenue on sale or return? Revenue is recognized on acceptance of customer. Okay. All right. Let me put all your things into one nice case study. Okay. And then let us discuss whether it is correct or not. Okay. Let us discuss whether it is correct or not. Okay. You have Amazon, Flipkart. Okay. Amazon, Flipkart have all these big, suppliers. Okay. They have all these suppliers who are registered on Amazon or Flipkart. Now, the CEOs of all these suppliers, they want to enhance their sales. They want to enhance their sales because they believe that they can do that. साल खत्म होने आ गया. On 30th of March, they tell Amazon, on 29th March, they tell Amazon that 30th and 31st March, please plan a big billion day sale. Okay. A big billion day sale where the sales can happen so that our performance also increases. At the same time, you are also benefited. So Amazon and Flipkart, all the suppliers on this particular platforms, they tell Amazon that please go ahead, we can plan a big billion day sale on 30th and 31st March so that even our inventories go down, we can also experience profits, etc., etc. So now on 30th and 31st, वो सारे orders आके गिरने लगे. You have crores and billions of orders which come and fall on Amazon and Flipkart. Now, Amazon and Flipkart sell on the sale is the invoices are generated on 30th March, 31st March. Please understand carefully. This is going to be very interesting. Okay. Now see. 30th, 31st March is your invoice date. And chalo, I will make it simple. Invoice plus dispatch plus receipt. All these things happen. All these things happen on 31st March. Hota nahi hai, but we will assume that it all happens. You invoice the goods, you dispatch them, you also the customer also receives those goods. These goods have a return span of 7 days to 14 days. That means if the quality is not good, the customer did not like, it's not fitting their sizes, if it is clothes, electronics went damaged, okay, they sent wrong things, okay. So all these things can happen in the big billion day. All these things can happen in the big billion day sale. It is a nightmare for everybody who is working at Amazon and Flipkart. Okay. But nevertheless, we have this. So till 7th April to 14th April, there is a timeline for return. There is a timeline for return. Either you return by that time, number one, or what you can do is, or you can, if you don't return, then it will be deemed to have been sold and revenue will be recognized. Now, coming to the discussion now. When should revenue be recognized? First one, sir, 31st March 20x1. Some people are saying 31st March 20x1. Sir, why? Invoice order came, invoice generated, goods bhej diya, and it has reached the customer also. So therefore, 31st March 20x1, all my obligations are fulfilled. First part. Somebody will say this. Okay. Somebody is saying, sir, you book the revenue after the return period is over. So 8th April or 15th April 20x1. Revenue will be booked in this period. Sir, why? Because the unconditional right to receive the payment is established on 7th April or 14th April. Until then, there is an obligation to refund what has been received by the customers. Until then, there could be an obligation to refund what has been received by the customers. So some of you are saying that, sir, we will book the sale on 8th April or 15th April as the case may be. So this is the second opinion. Third opinion is, sir, we will record the full revenue on 31st March X1 with a provision for return. With a provision for return. With a provision for return of the goods. With a provision for return of the goods. Are you clear? Yes. So you can do it this way also. Okay. And what other answers am I having? Yes. All right. So these are the various answers that I have been getting. Okay. That I have been getting. Now, sir, which answer is correct? Which answer is correct? Okay. Obviously, first answer is not entirely correct because you can recognize the revenue on 31st March 20x1. There should be something extra added to that. You cannot recognize the revenue on all the products on 31st March because you are going to Okay, you are not in a position to book all the revenue on 31st March because some returns could happen. Some returns could happen. So therefore 100% revenue book karna is not advisable from an accounting standard point of view. There were some people who said, sir, we'll book the revenue on 8th April or 15th April once the returns are done. Once the returns are done, once we cross the timeline, once we are absolutely sure. जिन्होंने ये आंसर दिया है, the people who gave these answers were the people who said that when we did that L&T and contract question today morning, these were the same people who said that, sir, we will recognize the bonus in the last year because until then, I am not sure when the contract needs to be performed. So therefore, the people who said 8th April or 15th April are the same people who are following conservatism very strictly in their life. I cannot follow this also. भाई ये तो unreasonable है. 8th अप्रैल 15th अप्रैल तक मैंने गुड्स भेज दिया, मुझे गुड्स अभी तक आए नहीं है, एंड यू आर सेइंग आई शुड नॉट बुक माय रेवेन्यू. अरे देन व्हाट इज द होल पर्पस ऑफ डूइंग द बिग बिलियन डे सेल? I did the big billion day sale so that my sales jack up in before 31st March and my profits also go up. But now you are telling don't book the revenue till 8th April or 15th April. वो गुड्स तो जा चुके हैं. हाँ, there may be some goods which may return back, but at least 95% of them will have gone through. So this suggestion also is not applicable. The last one was 31st March X1 plus provision for return. This is partially correct. This is partially correct. Okay. I won't say this is totally wrong. There is some truth in this. What is he saying is 31st March 20X1, we book the revenue, and along with the revenue, we shall also book a provision for return. We shall also book a provision for return. Now, in reality, how will it happen? Suppose you sold 100 units. Suppose you sold 100 units. Entry will be bank account debit. This is for 100 units of a product or 100 articles or 100 things or 100 items or 100 sets of goods. Okay. So you got the payment for 100 units. Okay. Now the next question is to revenue. Sir, आप revenue कितना recognize करोगे? Look at the definition of transaction price. Is it amount received or is it amount expected to be received? Is it amount received or is it amount expected to be received? What do you recollect? आज सुबह से I am telling you, from today morning I am telling, what is it? Is it revenue received or revenue expected to be received? Yes. Is it revenue? Is it transaction price? Is the amount received or amount expected to be received? Yes, expected. Vimal, Yadu, Manan, Rajiv, Mufita, all of you are right. It is amount expected to be received. So I have to make an estimate of the goods that will not be returned, for which I will recognize a contract liability. It is as if I received an advance. And for the balance, we will proceed and recognize the revenue. So to revenue, let us assume this is 95 units. Your estimate is 95 units will not come back. So therefore, you are going to recognize the revenue on 95 units. The remaining units represent a contract liability. The remaining represent a contract liability. And that is how much? 5 units. This will be selling price. This will also be selling price. This will also be selling price. Yes. Are we clear about this? Yes. So you will do the accounting of the expected revenue. You will do the accounting of the expected revenue. Don't postpone revenue recognition. Don't postpone revenue recognition. उससे कुछ नहीं मिलने वाला. You are not getting anything. You are in fact going against faithful representation. Those of you who said 8th April to 15th April तक don't book revenue, it means जो big billion day का इतना बड़ा sale है, the major sale of the year, the big billion day sale, if you take it as to be booked on 8th April or 15th April, your books are never going to show a true and fair view, because actually sales had happened. You have not recognized them. So that is your mistake. Okay. Now, suppose the question is, sir, we had estimated 10, but 20 units we are not, what you can say, 20 units are returned instead of 5. 20 units are returned, then next year may you reverse the revenue. Yes, next year may you can reverse it as a change in estimate. You can reverse it as a change in estimate. Are we clear with this? Yes. Am I clear? Yes. Any doubts, anyone? Yes. All right. Now let us move further. Story does not end here, my friend. You are not recognizing the revenue on 5 units. You are not recognizing the revenue on 5 units. If you are not recognizing the revenue on 5 units, you also have to reverse the cost of goods sold on those 5 units. So that will be inventory account debit to COGS. This will be in respect of 5 units. This will be in respect of 5 units. Are, did you understand? Yes, did you understand? COGS is going to be reversed. Why is the COGS going to be reversed? Because it is my inventory which is lying with them. It is my inventory which is lying with them. So therefore, उस inventory पे मेरा right है until they accept it. So therefore, inventory account debit to COGS. This will be at cost or NRV, whichever is lower. This will be at cost or NRV, whichever is lower. You will apply Ind AS 2 principles, because now you will have to check, you have to maintain it as per Ind AS 2. So therefore, you will book it at cost or NRV, whichever is less. Are we clear with this? Yes. Are we clear with this? Anybody has any doubts? So therefore, 31st March X1 booking all sales is not right. Postponing all sales to 8th April or 15th April, that is also not right. 31st March with a provision for return is the right way going forward, but with a modification. Provision for return nahi bolenge usko, we will call it as a contract liability. We will call it as a contract liability. And when you are booking a contract liability, you have to also reverse the corresponding COGS, that is COGS. Why do I have to reverse? Matching principle. In your P&L, you have shown only 95 units sold. 5 units is held as COGS, whereas you cannot compare that with your cost of 100 units. So you have to reverse the cost of 5 units to arrive at 95 units. Are we clear with this? Yes. So ये हो गया मेरा sale or return. Okay. This is my sale or return. So please go through this question for homework. It's too simple. Okay. It's quite simple. All right. That is concluding your sale or return. Then we do another small topic, that is restocking fees. Restocking fees. Okay. What do you mean by restocking fees? Sir, restocking fees means, suppose ये big billion day sale का ही example लेते हैं. Yes, Amazon placed, I mean a customer placed an order on Amazon platform. The goods are in Ahmedabad. The goods are in Ahmedabad. The order has come from Guwahati. The order has come from Guwahati. Matlab, from West India, it has to traverse Northeast India. Are you able to imagine the transportation costs involved? Yes, there will be a huge transportation cost that will be incurred for traveling from Ahmedabad to Guwahati in Assam. Now, ये goods भेजने के बाद, if the customer in Guwahati rejects it, again you return the goods back. And for all this sale and return, who will be responsible? For all these sale and return, who is going to bear the burden? Sir, ideally it should be Ahmedabad, the seller, who should bear the burden. But why he will bear the whole burden? See, if I sold the goods to him, if I have sold the goods to the Guwahati customer, I met my obligation. Now he is having a return request to be raised. Who will raise that request and come this side? Okay, who will raise that request and come this side? Are you able to understand? Yes. Who will meet the transportation cost from Guwahati to Ahmedabad? See, who will meet the cost from Guwahati to Ahmedabad? Do you think the seller is going to meet that cost? Do you think the seller is going to meet that cost? Obviously, वो मना करेगा, बोलेगा, why should I incur the cost? This is the what you can say, the buyer is the one that opted for a return, and because the buyer opted for a return, we are going to have to give your cost of transporting should be reimbursed from the seller to the buyer, because the whole distance the goods have to go back. So typically this aspect would be inbuilt in the contract. This aspect would be inbuilt in the contract. Okay. When I say inbuilt, what does it mean? When I say it has to be inwarded from Guwahati to Ahmedabad, the cost of the transport will be paid by the customer. In what manner? We call this cost, which is repaid, as restocking fees. We call this cost as restocking fees. Ahmedabad supplier removed it from his stock, transported it to Guwahati. The Guwahati supplier did not like it and pressed the button for return. Return comes with the criteria. If you want to return any goods, you will have to pay. You will have to pay for some minimal charges. You will have to pay for some minimal charges. Are we clear with this? Yes, you will have to pay some minimal charges. Those goods will come from Guwahati to Ahmedabad and you will restock them. You will restock them. So the customer pays the seller fees for transport and restocking. तो उसको हम लोग बोलते हैं restocking fees. We call that to be the restocking fees. Are we clear with this? Who makes the payment to whom? Who makes the payment to whom? The customer makes the payment to the supplier. The customer makes the payment to the supplier. Are we clear with this? Yes. Are we clear with this? इसको हम लोग बोलते हैं restocking fees. We call this only as restocking fees. All right. It depends on contracts between buyers and sellers, but typically a restocking fee is generally put in the contract because it involves efforts from the seller side as well. So the customer should abide by that. The customer should abide by that. Are we clear? Yes. Are we clear? Are we clear? Restocking fees. Yes. Anybody has any doubts? Clear. So now in this example, we have a contract liability. Now there is a return request that is raised. So we recognize the inventory account debit to COGS because inventory should come in my books. At the same time, we also recognize a restocking fees. We also recognize a restocking fee as our income. Okay, we also recognize a restocking fee as our income. Are we clear with this? Yes. So therefore, if I have to pass the entries, let us look at the help of an example. Okay. Let us look at the help of this example. An entity enters into a contract with a customer to sell 10 units of a product for rupees 100 per unit. The customer has the right to return the product, but if it does so, it will be charged a 3% restocking fee or rupees 3 per returned unit. The entity estimates that 10% of the units sold will be returned. Upon transfer of control of 10 units, the entity will recognize revenue of 903 plus 1 unit into 3 restocking fees per unit. A refund liability of 97 will also be recorded. 1 unit 100 minus 3 rupees restocking fee. Minus 3 rupees restocking fee. Okay. So this is what you are going to do. So now let us look at the journal entries that we are passing. First one is you are entering into a contract to sell 10 units of a product. Sell 10 units of a product. So now the entry will be bank account debit ten units into 100. So this is going to be 1000. Revenue 9 into 100, 900. 2. Refund liability 3 rupees. Sorry. Refund liability 1 unit into 100. वो मेरा liability है. 1 into 100. So that gives you 100. Yes, 1 into 100. Now, the next one is, the next set of entries is inventory debit to COGS. To COGS. Whatever it is. Yes. And then the restocking fees. So entry will be refund liability debit. I have to pay him 100 and collect restocking fee. I might as well, pay him the net amount. So refund liability debit 3 to restocking fee. Restocking fee. Yes. So my net refund liability is 100 minus 397. My net revenue is 900 plus 3, 903. And I got my Yes, 97. COGS is recognized. Net refund liability is 97. The total revenue is 900 plus 3, that is 903. So that takes care of restocking fees. Everybody has confirmed that they have understood it. Okay. All right. Just 2 minutes. Correct. So the refund liability, when it is paid, it will be refund liability account debit to bank, 97 rupees. Okay. So anyways, that takes care of restocking fees. Small things I think we have completed almost entirely. So much is there, no time. Okay. All right. Restocking fees is done. Sale or return is done. Warranties are done. Then we have variable consideration also is done. So now we have two components. That is, one of it is what we will do today. That is the significant financing component. A significant financing component. So what do you mean by a significant financing component in the transaction price? What do you mean by that? Sir, a significant financing component means the obligation is discharged at a particular point of time and consideration is received at a particular point of time. The time gap between both of this is greater than 12 months, and that is not what is the norm of the industry in which the entity operates. Sir, फिर से explain again. Okay, so this is significant financing component. Okay, so now obligation discharged, consideration received. Okay. Obligation discharged versus consideration received. This time span is greater than 12 months and you are generally, okay, Supraja is asking, will the refund liability be the same in the case of previous example as a contract liability? No. This is no longer a contract liability, madam. This is a actual refund that you have to pay. It is a cash liability. Okay, it is a cash liability. You have to pay it. It is a financial liability. In all the previous cases, you don't get confused between contract liability or any other liability. This is not the understanding, but I'm giving it in simple words to you. For now, you just understand contract liability is money received now, service or obligation to be rendered later. Strictly, this is not what contract liability is, but I'm just making it very simple for you to understand. Contract liability is money collected in advance, services to be rendered in the future, or obligations to be discharged in the future. So we call that as a contract liability. We saw that for warranty services. We saw that for the servicing. We saw it in a host of other cases also. So there you have your what you can say contract liability. Whereas the other case, all other liabilities are regular liabilities which you have to settle in cash. So they are two different things altogether. Okay, they are two different things altogether. Okay. So now coming to significant financing component, obligation discharged, consideration received, the time gap is more than 12 months. Sir, is it necessary that obligation should be discharged first and consideration should be received later? Not necessary. When obligation is discharged first, consideration received after more than 12 months, then the seller is financing the customer. The seller is financing the customer. But suppose you are having the customer pays money first and then discharges the obligation. The seller then discharges the obligation after more than 12 months. Then that is the case of customer financing the seller. That is the case of customer financing the seller. Now, when customer finances the seller, or seller finances the customer, there is an inbuilt financing component in this arrangement. And because of that, we have two performance obligations here. One is a sale of a product or a service, number one. Second is the finance income or expense needs to be accounted over a period of time. So first is revenue, you need to book it. Second is the second is your first is booking of the revenue, and the next one is booking of the finance costs. It could be income for the seller if seller is financing the customer. It could be expense for the seller if customer is financing. Whatever it is, the finance cost needs to be recognized. So therefore, your significant financing component will have at the minimum two obligations. One is your performance obligation. Revenue stream, performance obligation revenue stream, plus the other one is finance income or expense. The finance income or expense could be recognized on over a period of time, because the financing is happening for a specific period, whereas the obligation could be at a point in time or over a period of time, depending on the nature of the contract. Now let us take a case where we are having a scenario of cash price 30,000, 2-year credit facility that is given, the selling price becomes 36,000. You buy now, pay after 2 years. 36,000. So total 6,000 becomes your interest for financing. Okay. So this is the 6,000 which you will recognize over time. Cash price will be booked immediately. So entry is bank account debit 36,000 to revenue 30,000 to unearned finance income. This is 6,000. This is 6,000. And this 6,000 is right now sitting in unearned finance income. You will pull it to the P&L over the tenure of the obligation. Over the tenure of the obligation. Are we clear with this? Yes, are we clear? Any doubts? Anybody has any doubts? No doubts? All clear? Yes. Okay. Now, there are some exceptions to significant financing component. There are some exceptions. What are those exceptions? First one, the customer voluntarily makes the payment. The customer voluntarily makes the payment at his discretion. At his discretion. For example, suppose tomorrow Reliance Jio comes with a 2-year recharge plan, a 2-year prepaid recharge. Now, when Reliance comes with a 2-year prepaid recharge, then at that point of time, the 2-year prepaid recharge, strictly speaking, Reliance has to perform the obligations over a 2-year period. Customer has made the payment right now. So there could be a financing component, but the Ind AS tells us this is an exception. Why? Because customer has made the payment voluntarily. Reliance did not come and tell them you do the payment on what you can say on multiple. Reliance will say that what you can say, you give me the recharge, I will provide you over a 2-year period. It will be economical, but this is at the discretion of the customer. So Reliance is not giving any facility of financing to the customer. Okay. And therefore, significant financing component won't be applicable in such cases. This is the first one, exception. Second exception is if consideration is variable and variability of the consideration is not in the control of the supplier. Consideration is variable. Suppose you are a publisher of books. You published the books and you have given it to the all the bookstores, but nobody has what you can say variability of, but nobody can control the consideration. So you are an author or a publishing house. You have developed this book. You have given it for resale. The parties, the bookstores where you have given it for resale, they are reporting that we do not have any control over how the sale will happen. This will depend on various factors, and therefore I have to pay you the royalty after 2 years, but I cannot predict the amount of royalty right now because it depends on how many people actually buy your book, how many people actually buy the book that you have given. And that is why we regard it as an item which is not in control of the seller, and hence there is no implication of financing component. There is no implication of a financing component. And last one is any other case. Okay, there is no need to consider it as a loan. Okay, there is no need to consider it as a, is it okay? Yes. What are the other cases? Annual maintenance charges. At a time you pay 3 years. You have paid it voluntarily. Society has not demanded it. Society will take out only one year's this thing. Okay, only one year's expenditure. So you have paid it. So therefore, continue it as your what you can say. Continue it as your liability which you have received, there is no significant financing component, number one. Second, you have these classes which collect revenue from customers, from their students. So basically that is to protect their interest. That is to protect their interest. If you do not do that, then anybody can come and leave at their own convenience. Okay. Third one is construction of machines, missiles, equipment for defense, etc., where they have a concept of retention money. So this retention money amounts to what you can say a long-term financing arrangement, but that is solely to protect the position of the customer. Because tomorrow, if they do not hold the payment, then the customer will make the full payment. And when customer makes the, if they do not withhold, they make the full payment to the customer. And when customer receives the full payment, if there is any fault, if there is any repair work, if there is any damages that have happened, these customers need to fulfill those. These customers need to fulfill those requirements of the the sellers need to fulfill the requirement of the customers, and that is why you have the concept of retention money. The government keeps a portion of retention money. So if there is any defect in the product which is developed, the customer can come and repair it. So that is why the retention money is kept. Retention money span from 3 to 5 years. So apparently it appears that there is a financing component, but this is more from the perspective of protecting the interest of the customer. And that is why you have the concept of retention money. You have the concept of retention money. Is it okay? Yes, everyone? All clear? So 3 exceptions. First one is customer voluntarily pays. Second one is variability not in control of the supplier. And third one is exceptions like annual maintenance charges or retention money or what you can say warranty collected upfront. Whatever it is, you are having these many as your exceptions to the significant financing component. Exceptions to the significant financing. Are we clear with this? Yes, are we clear? Anybody has any doubts? Anybody has any doubts? Yes or no? All clear? Yes, okay. Now, we'll pick up a small question on this. Rest all questions you will be doing, but I'll be doing a couple of questions that deal with financing in the core. Okay, so then you can understand. VT Limited enters into a contract with a customer to sell equipment. Control of the equipment transfers when the contract is signed. So immediately the control transfers. The price stated in the contract is 1 crore plus a 10% contractual rate of interest payable in 60 monthly installments of 2,12,470. Determine the discounting rate and the transaction price when Case A, contractual discount rate reflects the rate in a separate financing transaction. And we are just completing this one question and we'll wind up, Vanshika. Okay, I know it's a little heavy today because the concepts were a little complicated, I suppose. And above all, today is a Sunday. Okay, but just let me complete this financing component at least. Then on Monday, we have step number 4. And I'll see how I can plan step number 5. I may request for an additional class at some point of time so we can solve the questions. Okay, but just give me some time to wind up. This one question is important. Okay, the price stated in the contract is 1 crore plus 10% contractual rate of interest payable in 60 monthly installments of 2,12,470. Okay, now the thing is determine the discounting rate and the transaction price. Okay. See, when my customer pays the money and when the performance obligation is discharged, if there is a time gap greater than 1 year, there is an unearned finance income for one of the parties and an unearned expense for the other parties. The question is the rate which one we should take. Which rate of interest should we take? If you recollect AS 19, you had done leases. You recollect AS 19, right? You also would be doing Ind AS 116. So in these cases, they have taken internal rate of return, IRR. The rate of return which matches the minimum lease payments with the fair value of the asset. So if there is a rate that equates the minimum lease payments with the fair value, that rate would be called as the implicit rate of return or the internal rate of return or the IRR. Okay. In the revenue standard, the treatment is opposite. In the revenue standard, the treatment is exactly opposite. We have to rely on IRR as a secondary choice. Our first choice is incremental rate of borrowing. Our first choice is incremental borrowing rate. What do you mean by incremental borrowing rate? Incremental borrowing rate means what is the rate that banks will charge if you have to borrow the money from the banks. Internal rate of return is the rate which matches the outflows with the inflows. The present value of cash outflows with the present value of cash inflows. That is your IRR. IBR means what is the rate that will be payable if you were to obtain a financing from the bank today itself. So that is what is your incremental borrowing rate. That is what is your incremental borrowing rate. Now, in this question, determine that the price stated in the contract is 1 crore plus a 10% contractual rate of interest. This 10% contractual interest reflects the rate in a separate financing transaction in case A. So contractual rate of interest means this rate becomes my IRR. It is related to the contract. So it becomes my IRR. And they are saying that this rate reflects the rate in a separate financing transaction. Separate financing transaction means if you had to go to the bank and borrow the money, we call that as a separate financing transaction. So in the first case, IRR equals incremental borrowing rate equals 10%. Equals 10%. In case B, contractual discount does not reflect the rate in a separate financing transaction. That means IRR equals 10%, which is given to you, whereas the bank rate, the incremental borrowing rate is 14%. So now you have to do the accounting of the revenue in this particular case. So let us look at from where do we need to start. Yes. Let us look from where do we need to start. Now, please pay attention. This is illustration 39. Vanshika, you are there, I hope. Okay. All others, I hope you are there. Okay. So illustration 39. Consideration equals rupees 1 crore. Consideration equals rupees 1 crore. Now the next one is EMI equal monthly installments is how much? Sir, that equal monthly installment is 2,12,470. 2,12,470. Now, in the first case, they have said that IRR equals IBR equals 10%. If IRR equals IBR equals 10%, that means my transaction price will be equal to the fair value. My transaction price will always be equal to the fair value. If IRR is not equal to the incremental borrowing rate, then my fair value is going to flare up, is going to change. Okay, fair value is going to undergo a change. So the first case they have given IRR equals IBR. That is why we are saying transaction price equals fair value. That is the price expected to receive for the performance obligation. That means this is going to be your revenue. This is going to be your revenue. Those of you who understand, which webinar is there? Manish, which webinar is there? Just give me 5 minutes. Okay. Now, you can either take this as a rule, or what you can do is you can confirm it with a calculation. You can confirm it with a calculation. Present value monthly factor you will have to do of 10% for a period of 60 months. For a period of 60 months. Present value annuity factor. Okay, this is 10% per annum. You will have to do it on a month-wise basis. So that is basically 1 divided by 1 plus 0.10 by 12 for a period of 60 months. For a period of 60 months. That means it will be 1 divided by 0.1 divided by 12. 0.1 divided by 12 gives you 0.00833. 00833. This you will do raised to 1 plus 1.00833 raised to 2 plus etc. till 60. So the total of that comes to, you can check this out by yourself, 47.065,369,023752. So now, when you multiply your EMI into the present value annuity factor, 2 crore 12 lakhs 470 into 47.065, you are going to get 1 crore. You are going to get 1 crore. You can either do this the long way, or you can make this assumption that since IRR equals IBR, the transaction price equal to the fair value. It will be the same always. It will be the same always. So the entry that you are going to pass is, first one, debtors account debit to sales. This is 1 crore. This is 1 crore. Okay. Next. First month. Month 1. Okay. Month 1, the entry will be debtors account debit to finance income. This will be 1 crore into 10% into 1 by 12. So this will be 83,333. 83,333. And then you will be having debtors paying the money. So bank account debit to debtors, this will be 2,12,470. And this cycle will continue for a period of 60 months, at the end of which the debtors will become 0. Now, if you consider IRR equals 10%, IBR equals 14%, which rate are you going to use for transaction price? You will be using IBR, because this is Ind AS 115. If it was 116 leases, you would still continue to use the IRR method. Okay. Now, IBR equals 14%. So therefore, the present value annuity factor is equal to 1 divided by 1 plus 0.14 for 12. This you will have to do it for 60 months. This you will have to do it for 60 months. The total of this comes to, the total of the present value annuity factor 14% for 60 months comes to 42.977016470,764. Okay, this is what it comes to. So now your EMI into PVAF is equal to 2,12,470 into 42.977. So this is equal to 91,31,327. This represents your fair value or consideration expected to receive. Consideration expected to receive. Okay. So this will be the basis for recognizing your revenue, and the remaining is going to be your unearned finance income, which you will recognize every month. So here the entry will be debtors account debit to sales. Debtors debit to sales 91,31,327. 91,31,327, and then you will be having the financing, debtors account debit to finance income, or interest income, 2,12,000, sorry, not 2,12,000, 91,31,327 into 14% into 1/12. Every month you will have to do this. 1,06,532, and then you record the payment. You then record the payment. Bank account debit to debtors 2,12,470. 2,12,470. So this is the entry that you will pass every month. At the end, the debtors will also nullify, and the finance income would be recognized entirely. The finance income would be recognized entirely. So if you see the solution which is there in the question, if you see the solution which is there, just give me warranty. Okay, 37, 38, 39. So you can see here, evaluating the discount rate, market terms means that cash selling price is 1 crore. We also determined 1 crore. In the second case, they are saying that cash selling price is 91,31,346. We have said 327. Difference is on account of rounding off. 60 monthly payments discounted at 14% per annum. Recognizes revenue and a loan receivable for that amount. Entity accounts for the loan receivable in accordance with Ind AS 109. So I want you to go through this question again, and apart from that, please go through all the questions related to significant financing component. Okay. On Tuesday, let me see how much I can really complete, because only one part is there in the transaction price, that is payments to customers. Non-cash consideration is a very small portion. In fact, I would suggest you to go through the non-cash portion by yourselves once, and the payments to customers is what I will be handling on Tuesday, followed by allocation, and then maybe revenue recognition I can just touch up. Okay, so with that I conclude the session for today. Thank you everyone. I hope you guys are able to understand something. I feel that many times I'm not able to reach out to you efficiently. Yes, it has been a little heavy today and yesterday and today, but what to do? There is no choice. You have to do this. Okay. So I hope you are going with some value addition after each class from my side. Thank you everyone, and see you guys on Sunday, on Tuesday. Not keep you waiting for the institute. Okay. President, please listen to the president, whatever he has to address. Okay. See you guys on Tuesday. Thank you everyone. Thank you. Thank you. Okay. So that's it, sir. Session concluded.